Good morning or good afternoon, everyone. We are going to get started in a couple minutes, but wanted to let folks trickle in, as they say. So welcome.
They're trickling, Rob. They're trickling.
That's a curious word, Alex. Matriculate. I've always been intrigued by that word.
By that word. Was that a word of the day on a word of the day calendar that just stuck with you?
I think it was on the back of my cornflakes when I was 8 years old, and I always wanted to do it. I never did. Anyway. So, Alex, where are you today?
I am stationed at home. I'm at my home office in Bel Air, Maryland right now. Where's everybody else? That's a good question. Where are you, Rob?
I'm in California. David, where are you?
I'm calling in from St. Louis.
Nice.
And Dr. Fratantoni?
I'm at MBA headquarters in DC.
Very good.
I'm closest to you, Michael.
Yeah, like a wrist rocket ball bearing shot away, maybe.
That's right. That's exactly right.
All right. Dr. Fratantoni, is it okay if we call you Mike during the session?
Please do.
Okay, good. And
His
David,
friends call him doctor, but everybody else calls him Mike.
I made the mistake once of putting Mr. Fratantoni in my commentary one time some years ago, and I try to live my life never receiving an email with the signature line of general counsel on it. But I got one from the NBA's general counsel saying that I needed to refer to him as a doctor and not a Mr. So
Yes. I will not make that same mistake, Michael. Dr. Mike.
all right, well, let's get going here. This is quite the environment. It's always quite the environment with mortgage banking. It seems like with as an industry, we are on the cutting edge of news that goes on around the world, news that goes on in the United States, economic news, pandemic news, psychology. There's all kinds of things going on that impact us, and that we try to not so much overcome, but keep abreast of and try to forecast what's going to happen next month, next year, next week. And that can involve, staffing decisions, company decisions, loan product decisions. There's all kinds of decisions that people in residential mortgage banking make every day and every week. And so what we're trying to do in this session, given what's going on out there, is try to put some sense into things and keep things in perspective, because frankly, the last year or two, we've seen all kinds of we've seen lots of all cash offers that are going on in the real estate arena, crazy bidding wars, soaring prices, no inspection clauses or inspectors showing up at open houses. Lately, inflation has picked up beyond the Fed's target. So it's a crazy world out there. I think it'll always be kind of a crazy world out there. And we've got three great panelists on today. Starting with Dr. Starting with Mike, who is the MBA's chief economist. And Mike and I go back a ways, and he knows I have the utmost respect for him and the work that he and his team do. So, and then you've got me, who sends out this little daily commentary. And but my background is primarily capital markets, and that's what interests me most. So then, Alex, we've got you, who's you think about serial fill in the blank. You don't want serial killer, but you are truly a serial entrepreneur. You've been named to the 40 under 40 by National Mortgage Professional magazine. You all these awards and accolades and so forth. And Sales Boomerang, can you talk a little bit about some of the awards that Sales Boomerang has won here within
my
the last
goodness.
year or two. Just spend like 30 seconds doing it because
Yeah, thank you for that. So the biggest one that we're most proud of is number one, fastest growing company in a mortgage tech space by Inc. magazine, number 101 in the country, fastest growing private companies without funding, number 49 on the Deloitte Fast 500, number 2 in the state of Maryland, fastest growing companies. Just so many things. Just makes you so proud to be part of a team like this.
what I think is interesting is that your awards have come from not necessarily inside the industry, but outside the industry, because, I'm not going to talk negatively about some of the awards that are awarded within the mortgage banking arena, but, some groups you can pay and get an award. Others, I think yours are won through hard work and through recognition. I think that's really neat. And then David, where are you today?
Based in St. Louis, calling in from the Loop.
So you're the founder and CEO of Capacity. And if I recall correctly, it's an enterprise artificial intelligence SaaS company. And yeah, headquartered in St. Louis. Does that sound about right?
That's correct. Yeah, we're based in St. Louis, been around for a couple of years, and been really enjoying building the business and growing and working with great folks who are on this call.
Now, did you grow up in St. Louis? Because that's not typically known as a mortgage hub.
I did. Yeah, I'm a local boy. So went to WashU and stuck around in town, and I like the Midwest. We're good corn-fed people here.
Good. You take visitors to the Budweiser brewery tour once in a while.
Absolutely.
Good. I've actually
He's there right now, actually.
What's
He's in
that?
one of their
Yeah,
boardrooms.
this is actually a Zoom background. I'm actually drinking some Bud Light right now.
David, you'll be happy to know that I've been in the courthouse where the Dred Scott case was decided. I went there with my kids several years ago.
Yes.
And as a quick aside, I know the audience isn't tuned into this, but we went to all 50 states, and occasionally we would go to sporting events, and we went to a St. Louis Cardinals game. And at one point my son said, "Look at what everybody's wearing." And we were like in gray or green or some, regular colors. And everybody in that stadium was either wearing white or red. So we definitely stood out. A huge fan support there for the Cardinals.
It's a big baseball town.
Yeah.
Sure.
Anyway, so I know that the panelists are chomping at the bit here to start talking about things. This is going to be a little bit of an interactive session, and I wanted to prime the pump here, as it were, with a question. And I wanted to answer. I wanted to hear everybody's thoughts on, as you can see on your screen here, 3 words or less. What is your biggest fear for next year? And I think that if you type those into the chat box, I think we can. You'll see that margins and volumes are big ones. The lack of inventory. Yeah, there are more.
Rob, you want everyone to type something in, right? This is for everyone to put their
everybody
thoughts.
should type something in.
Yeah, nice.
Profitability. I think that way everybody can see it, right? But there are more realtors.
Wow.
Than there are listings right now, which is really something. Yeah, inventory from Mr.
Cash
Farrell.
offers, which you mentioned earlier, Rob, that just came up.
Which one?
Cash offers, that clients are getting killed by cash offers. Tony said realtor referrals. That's the biggest fear. Very interesting.
Yeah.
Someone on here, retention and recruiting talent for sure.
Yes. Interest rates.
Interest rates. Yeah, we're going to talk about interest rates. I know Dr. Mike is going to talk about interest rates to some degree here, and I think that'll be interesting. In fact, why don't we jump in? I think that's the next slide, and I think Mike, why don't you take it away? And if you don't mind, I may interrupt, or David or Alex may interrupt with questions along the way. So, what's going on out there with refis and so forth?
Great. Well, thanks, Rob and Alex, David. Good to be on a panel with you. David, you might know Bob Roachman and team. We were just in Clayton, Missouri a couple of weeks ago for the CEO listening tour, meeting with a group of St. Louis lenders. Great town. So thanks for having us.
Yeah, for sure.
I'm going to kick off just with a bit of a look back. You know, obviously 2020, 2021, phenomenal refinance years. You look at the red line here, that's showing the refinance index from our weekly application survey. You know, you see that spike that happened back in last March, right when pandemic lockdown hit, rates just plummeted as the Fed brought short rates down to zero, started kicking off their asset purchases. And, you know, that refi wave, you know, we had a $4.1 trillion year last year, about 2.6 trillion of it refi, about 2.4 trillion this year. So $5 trillion of refinances over 2 years. It's about 15 million refinance loans getting done, right? Just phenomenal. That's
wow.
The wave that this business has been riding on. But if you look at the right side of this page, you know, rates beginning to creep up. So we were below 3% last year. Look at that blue line for a 30-year mortgage rate. We're up to about 3.3% now. The number just out this morning from our weekly application survey, down another 7% in terms of application volume. So, you know, in terms of the retrospective, 2020, 2021, phenomenal refinance years. But if we go to the next slide, you know, looking forward.
Hold on. Question.
Yeah, go ahead.
I think everybody understands the right side of the graph with, you know, rates, interest rates, 2.5, 3, 3.5, and so forth. When you talk about the index on the left, 1,000, 2,000, 3,000, what does that mean? 2,000, 4,000?
Yeah.
Great question. So it's a relative measure of how many refinance applications came in during each week compared to our baseline period, which was March of 1990. So if March of 1990 was at a level of 100, 2000 is 20 times the level of refi volume that we had in March of 1990. So that's the way to think about it. You know, I think, you know, the other way to think about it is, you know, look at 2018, which was a purchase market year, a fairly low refi volume year. That refi index was between sort of 800 and 1200, right? And then the peak in March of 2020, we were at about 6,500. So this morning's number, we're at 2,300. So kind of in between those extremes, but our expectation is we're heading back down to those sort of 2018, 2019 levels. Does that help?
Yeah, thank you very much.
Very helpful.
Cool thing. All right, so this slide really is the look ahead. And, you know, I think this is what many people look to MBA for in terms of a forecast of origination volume. And Rob, as you know, forecasting is an exercise to keep you humble because you're wrong all the time. But hopefully the information here is, yeah, the information here is useful, right? So, you know, that's the sort of term of art, is that all forecasts are wrong, but some are useful. And so how could this be useful? Well, directionally, where do we think we're headed? So if we were at 4.1 trillion in 2020, about 3.9 this year, we think we're going to be at 2.6 trillion next year. That's a pretty big drop in volume. And whether you look at our forecast, at Fannie's, Freddie's, numbers may be a little bit different. The direction's the same. We're all looking for a pretty substantial drop in volume next year. And if you look at the colors here, the green is refi, the yellow is purchase. The two parts of the market go in a different direction. So Rob mentioned the Fed, you know, just yesterday, Chair Powell suggesting they're going to speed the pace of their taper. So they're going to be backing away from the market faster than people had expected. They're probably going to raise rates on the short end of the curve faster than people had expected. All that means refi is likely to come down. So we're projecting about a 60% drop in refis. But if you look at the yellow, we're also looking for about a 7% gain in purchase. And that 1.7 trillion in purchase, that's an all-time record for purchase volume. And we see it going even higher in 2023. So, those lenders that have really been focused on refi the last couple of years, and understandably so, just given the unbelievable volume we've seen, this is turning the direction of the ship, right? That, a lot more time out there working with real estate agents, with builders, developing those relationships so you can take advantage of this really strong purchase market. So let me stop there. Rob,
it's a good foreshadow, Mike, for things we're about to cover in here, because we're talking about overcoming the fear, and what you're talking about are things we're about to be discussing with this audience is, those realtor relationships and also talent, a lot of the concerns people had. So I think that's a great foreshadow.
Yeah, Mike, I think, yeah, you know how I feel about predictions and forecasts. To your credit, I think this is very useful. I look back for when I need to laugh. I look back at all the predictions and forecasts that were being made in January and February and early March of 2020 about things. And obviously, in this kind of environment, we are driven by headlines, and I make that point in my commentary quite often, that it's nice to have a prediction, but all it needs is we get a new variant, and we go to hell in a handbasket for a day or two, and then the ship kind of rights itself. Do you think that the industry, so many people base their decisions on, or I should say, base their decision making on what you and your team are predicting in terms of purchases versus refis versus overall volume? Do you think that you have the what I should say, what would you do with this information if you were a lender who was watching this right now?
Great question.
And how would you best use this information that you guys have put together? And you put together very well, and makes a lot of sense to me, but how would you use it? How would you apply it?
Yeah. So what I advise people is to always think along the lines of scenarios, right? So what I just talked about, this 60% drop in refi, 7% increase in purchase, that's what we think is the most likely path, given the path for the economy, the unemployment rate, housing market, everything else, the actions of the Fed. I think that's the most likely path. But I think from a business planning standpoint, you got to consider more than just one scenario, right? Think about two other ones, which I think are absolutely realistic as well, right? One, we're all focused right now on the latest news around the Omicron variant and potential for that to slow the economy again. And you see that in the reaction with market rates of, rates dropped as soon as that news began to develop. So you probably should have in your back pocket a plan for what if rates don't go up? What if we don't see this really sharp drop in refi? Do I have the flexibility and capacity for my business to handle it if instead of refis dropping 60%, they drop 30%, right? I think they're still likely to drop, but obviously that's sort of the level of flexibility you need to have on that side. You got to think about the other scenario too, though. And for the first time in a long time, when I get pushback on the forecast, people are like, okay, you're crazy because inflation's running at 6%. The Fed's going to have to be incredibly aggressive. We're going to see a 5% mortgage rate next year. You're predicting a 4% mortgage rate by the end of 2022. I think it's going to be 5 or 5.5. That's a scenario that I think every lender needs to think about too, right? What if instead of this path, which is a pretty optimistic one for the purchase market, we get just a sudden stop? Remember the end of 2018, mortgage rates got to 5%, purchase volume just collapsed, right? You should think about that kind of a scenario too, where rates spike. And then sort of the art of this is, okay, Mike says the path I'm showing you here is the most likely one. Think a little bit about heating up of the pandemic again, rates stay flat, or what would that look like? That's less likely. And, think a little bit about this rate spike path. But I think, every CEO of a business has got to put their own thoughts. Okay, well, actually, they might think the pandemic path is more likely. They might think the rate spike path is more likely. But a real durable business model, you got to think about, can you survive through either of those scenarios? So that's
Great.
the way I think about it.
Yeah, I think
Great.
so. I was, as a quick aside, I was on a panel early 2 or 3 months ago, 4 months ago, or whatever, where a well-known forecaster was up talking to the audience of brokers, and this person was saying that the 10-year yield could easily be below 1% heading into 2022, and all the brokers were, they're salivating, chomping at the bit. And I sat there thinking, I just don't see that. But so I agree with your numbers personally. With regard to the chat room here, there's a good
some great questions.
William, do increases in home values and mortgage limits increase your cash out refi volumes in these numbers?
Yeah. So let me actually get two of these questions, because I agree they're great questions. So of the green portion of the bar that are refis, we're in 2020 and 2021. Vast majority of those were rate and term refinances. In 22 and beyond, our thinking is 80-90% of those are cash out refinances. So given the rapid run up in home prices that we've seen, a lot more opportunity for both cash out refinances and also closed end, open end home equity lending. Then the second question from Craig, which is a great one, why does Mike think purchase volume is going to rise year over year? Really a handful of factors on the fundamental side driving that, all leading to very strong housing demand. First, the demographics are just phenomenal right now, right? So if you look at the age structure of the US population, 4.7 million 30-year-olds. Peak first-time homebuyer age in this country is 32 or 33. So as that wave moves forward, it's just a lot of housing demand. They may buy, they may rent, they're going to live somewhere, and you're either going to be financing them or their landlord. It's just the need for housing is so great, just in terms of number of bodies. Household formation is running about 50% higher right now than it was a decade ago. Job market's improving. We're at a 4.6% unemployment rate in October. I think we'll be at 4.5 with the announcement Friday. I think we'll be at 3.5 by the end of next year. Very strong job market, wage growth. And then you have mortgage rates, which even if they go to 4% by the end of the next year, are still historically pretty strong. So demand is there. The challenge is supply. And actually, if we go to the next slide, I think the biggest challenge to this purchase forecast is this picture right here. So we all saw the news yesterday with the increase in the conforming loan limit. So 18% gain up to 647K. Every home price measure you look at is in high teens in terms of year-on-year growth. So that's the orange line. Income's growing between 4 and 5%. Right? That is a big disconnect. So our hope is that the builders are able to put enough new inventory onto the market to really calm this down a bit. We need home prices to be growing more in line with income growth. Income growth looks good, but to your point of more realtors than homes for sale outright now, that's just not a sustainable path. So we're forecasting that this home price growth is going to decelerate. So still see home prices going up, but it's not nearly as fast next year.
Mike, how much of the supply is tied, the tightening of the supply before it can get loosened up has been tied back to the supply chain issues everyone's running into in terms of just commodities, et cetera?
Yeah, great question. So you heard about, lumber prices spiking last year. This year, every other input to home construction, whether, windows, copper wiring, appliances, have been in short supply. It's adding to the cost of a new home. And sometimes it's really slowing down the ability of builders to put up new properties. So it's definitely having an impact. But, we have more than 700,000 homes under construction right now. So they're on the way. And I think, builders are doing everything they can to pick that up. I think next year that'll get better. Really where inventory has been tighter has been on the existing side. So just about 1.3 million existing homes for sale, 2.4 months of supply, where typically you'd expect about 6 months in a balanced market. The trick here is getting enough new homes out there so that the move-up buyers move into those new homes, because they tend to be at a higher price point. That frees up some entry-level supply for those first-time buyers that I said are going to really be driving demand. But watch these home price numbers really closely, because you talk about risks to that purchase forecast. I think one of the bigger ones is this picture right here, that if we don't get this home price growth down a bit by getting more inventory on the market, that'll be pricing out those first-time buyers.
All right. Well, thank you. I mean, we could have a whole breakout session, Mike, with the numbers that you and your team have put together. So thank you. But we can come back to you toward the end of the session again. But I wanted to turn the kind of the slide deck over to Alex. I know that Alex, Sales Boomerang, just sees a wide range of clients, an amazing range of clients. And so I wanted to hear what you had to say about what your clients are afraid of. I wouldn't even say afraid of, but what are their eyes on for 2022, and what's Sales Boomerang, and what are you guys doing about it?
Yeah, I love that. Thank you. And Mike, that was excellent. Thank you. And the questions and answers to the questions are just phenomenal. I love this conversation. So a lot of really interesting and exciting things are happening at Sales Boomerang with Sales Boomerang clients, and in general, what we're doing here as an organization. For all those listening, understand that our mission is one thing, right? And I wear it on my shirt. You see it, guys, all the time. No borrower left behind. That is our mission. And when we add to that mission is every borrower in the right loan right now. So not that just they're not being left behind, but they're in the right loan right now. And so here's what's exciting. If you see down at the bottom of the screen here, you see 3 different notifications called cash out, rate and term, FHA, MI removal. Those are loan scenarios, okay? And over the last, I'd say 3 weeks, about 3-4 weeks, we've had so many of our existing clients say, hey, I finally can say to you, we need volume. We're seeing the numbers start to slow down. We need volume, right? And the volume that they're looking for is volume of opportunities that they know they can add value, not just random volume and hopefully I can sell somebody something, but truly those people that these lenders can add value to. So with what we've seen over the last few weeks is this real demand and interest and excitement of, can you please point to me the people in my database that I can offer this value to, because my voice resonates more than a random new voice that may sound like a sales pitch. Whereas Sales Boomerang gives lenders the ability to be value add, and you'll hear from David. He does his system does something very similar, and in a different way, but the same purpose, right? We're giving the lenders the ability to add value and sound like advisors, not salespeople, serving, not selling. And so over the last few weeks, we've heard a couple things. We need volume, and we need to have better conversion ratios. Like, we need to be able to get these people to move forward once they see the value and not kick tires and wait for things. So as you know, Rob, but for everyone listening, our goal and our North Star at Sales Boomerang, and how our clients are overcoming the fear of what's happening in 2022, is creating a baseline of predictable results from their own database. So we're able to look at a database of, let's say, 100,000 records, 30,000 records, and say, look, from your database, this is what you should expect this year, right? And that's a baseline. So imagine as a lender, you're saying, look, next year we need to do 1,000 loans, and we can show you that 450 of them can come from your database. Then all you need is 550 new opportunities, which, by the way, there's a way to get there from getting referrals, from getting your realtors to. There was one of the fears. One of the fears is, hey, am I going to get realtor referrals? Yes, you can, because you're going to be able to give them deals back as well from having insights on your database. Look at the top row of what you're looking at right now, everybody. The top row talks about the results that lenders have experienced over the 4.5 years that we've been in business. 24x ROI. They invest $1, they get $24 back in return. 20 to 40% lift in volume in just the first 12 months. An average cost of converting a customer from your database. And by customer, let me be clear. Your database is your leads, your prospects, your turndowns, your pipeline. It's not just the people you've done loans for. That is a part of your database, but that's not the only part of your database. And there's this tunnel vision with lenders that is, my retention is for my customers only. No, the people you've spoken to, your leads, your pipeline, your prospects, the turndowns, they're your customers too. They just didn't buy yet. Okay. And so it's important to understand that. And that is where your gold is going into places, into times like 22 and 23. Look at this statistic on the right, and then we're going to go to the next slide. 11.69%. This is very important to understand. A few months ago, if you watched this slide transform over time, you saw that number say 13+%. 13+% of your entire database could have a mortgage related event every single month. Not anymore. We've seen, right? You just saw Mike present the data on this. You've seen the numbers go down, the number of opportunities, the people that actually benefit, the people that can actually benefit from doing a mortgage, either a purchase or a refi. That number is declining, and our numbers are showing the same thing, but still 11.69% means that over a course of the year, if that number stays similar or close to there, over 100% of the people in your database will have a mortgage related event. The question is, will your competitor be able to offer them something before you do? Or do you have the advantage of being able to offer them something of value now before they go to the market? And that is our entire mission here at Sales Boomerang, making sure that your customers are your customers, your pipeline, your turndowns are your customers. They just haven't bought from you yet. Okay. So this is how our clients, this is how the Sales Boomerang team of lenders, family of lenders are approaching this fearful time of 2022. What do we do is they're looking at their baseline. How do we create a baseline? We know that this is what we're going to get from our database. And what's the gap? What's the differential? What is left for us to fill in that gap? And then they're focusing on that and knowing that we have a baseline, and let's try to go above and beyond what our goals are, because we know we're going to get this out of our database this year. So if we go down to the next slide, unless somebody has a question here, Rob, Dave, Mike, anyone?
I'm good. Very thorough. Appreciate it.
Okay. If we go to this slide, this is very important. This is a slide, and these numbers are from November. Okay. We're always giving you the most relevant, most recent numbers. This isn't last year. This isn't 6 months ago. We want you guys to know exactly where people are today. And we chose a group, a lender, to show here that is not over 100,000, 200,000 records, not below 10,000 records, somewhere in the mid-size level of a lender that could have a number of records to be tracked. This is a group that has 37,000 records in their database. Why are we sharing this? Remember, we're talking about overcoming the fear. Where are we going to pick up volume? Where are we going to pick up the deals? We don't want our cost of acquisition to be $2,000. We need it to be closer to $500 so that we can make a profit and still run a successful, healthy business. This is that path. This is the way to get there. Look at this example. This group has 37,000 records. Day 1 of November, they had 79 opportunities from within their own database, $19 million worth of volume from their own database of opportunities. The first week of November, 621 opportunities from their database, right? Who's going to listen to you? Who's going to respond? Who's going to give you a chance to be heard? One of the most difficult things that we hear from the lending space is we just wish the customer would hear us out. Just that's all I want. If they give me a chance to listen, that's all I need. I'm not trying to sell them. I'm trying to advise them. They won't even listen to me. But who will? The people you've already been in contact with. Try to help out. Been there for them, right? They will give you a chance, a much greater chance than a random call from a random lender. Okay. So think about your database as your farm of opportunities and the people that will give you the leeway that they may not give someone else. And again, just to drive the message totally home, in the first month, not the first month, in November, 1 month, almost 2,000 opportunities for $500 million in volume from their own database. So how are Sales Boomerang lenders facing this fear or approaching this fear? They're creating a baseline. They know their database is active. They know they will be listened to. They know they can add value, and they are seeing conversion rates triple, quadruple, 5xing random leads buying things online, competing with 4 or 5 lenders every time you buy a lead. They're still doing that, but they're burning the candle at both ends. If you enter our house, or as I like to say, Rob, our hotel, right? We turn you into Hotel California. You check in, but you don't check out. You are now our customer, and we will know when we can help you again. Now, that's how you asked the question of how our lenders are doing it. Let's go to the next couple slides here. Something very exciting. We don't want you guys to go the way of the dodo, okay? Which is extinct. We don't want everyone on this call. This is a chance to not go extinct, to not let 2022 be the year that the comet hits the industry and a lot of people go extinct. That's not what needs to happen here. So what are we doing about it? Let's go to the next slide. Perfect. So what is hot in 2022? Okay. How are we making sure that our clients aren't stuck, that the industry isn't stuck? Just like David, just like Rob, just like Mike, Sales Boomerang is a selfless organization. We do this for supporting the growth of the entire industry, not just the people using Sales Boomerang. Okay. So one of the solutions we're rolling out, this is going to be a big deal. There might be some things in chat is, oh, there's the cash out popped up. Look at that. I was going to start with the reverse. One of the things we're rolling out is a whole new reverse program and reverse notification. So there's been a lot of regulation changes in reverse, a lot of great new opportunities. It's a wonderful program. It's a great way to help a customer in need. Okay. So we're rolling out a reverse program. We're rolling out one of the most sophisticated. It's already out. We're making it even better. Cash out. Mike, quick question for you. It was in the chat. There's a ton of equity. Is cash out still going to be a relevant loan in 2022? What do you say?
Oh, definitely think so. I think it is going to be tough to convince someone that took a 2.5% rate to cash out at a 4% rate, but it's going to take some time to get from here to there. And in the meantime, aggregate home equity is as high as it's ever been. And there are a lot of homeowners out there who are going to need to finance big purchases. Cash out is going to be an opportunity for them.
Fantastic. And guess what, everyone? We have put together the most sophisticated, easiest to use cash out notification in the industry. It literally notifies you who in your database can benefit from a cash out with you, not the industry, with you, not the market, with you right now. Listing Plus, improving your opportunity for getting as many listings as possible. It's a brand new program we're rolling out in 22. Exclusive agent relationships. You guys mentioned this. We are giving our lenders, the industry, the ability to create exclusive agent relationships. Those that are using Sales Boomerang, I won't ask you to go back a couple slides, but if you remember all the opportunities that were created in just 1 month for that one lender, 2,000, just imagine for a second, 30% of those are going to be purchase related, maybe more. Going into the new year, it's going to be more, but let's keep it at 30. That's 600 referrals that you can give your agents. Think about that. 2,000 opportunities in 1 month is 600 potential purchase referrals that you can give to your agents. You want to create exclusive agent relationships? Give them more deals they give you. They will not go anywhere else. We have a whole program for that. And this is a mission. This is important. I'll stop here because this is a radical big thought. No more mortgage inquiry alerts. This is one of our new missions. What is a mortgage inquiry alert? A mortgage inquiry alert for our clients means somebody in their database is shopping for a mortgage with a competitor. They're cheating on you with another lender. And everyone's like, it's a very important notification. We must have it. Yes, it's important, but it is also a defensive play. The goal is to transform the retention rates in this industry, not improve them, transform them. 18% is a very low retention rate for an entire industry. To transform that, it means we need to stop focusing on getting mortgage inquiry alerts, and we need to eliminate them altogether. You as a lender should have your clients come to you first. If you're getting a mortgage inquiry alert, it means they didn't believe in you to come back to you first. Our mission is to stop that. Our mission is for you to not get mortgage inquiry alerts because you are the one that your clients start the mortgage conversation with. And after they started with you, maybe they didn't hear what they like, then they maybe go to the market. But they should not go to the market. They should go to the trusted lender that did their loan last or that they spoke to last. There's no reason to speak to others. You should always find a way to build that trust so that your borrowers come to you for every next mortgage transaction. That is our mission. That is what all of these offense-driven first step conversations are all about. These loan scenario alerts are all about. So what's hot in 2022? Don't go the way of the dodo. think about all of these additional things to help you get in front of your customer first and not let them go to the market. So I hand it off to you, David.
Yeah, thank you, Alex.
Thank you. That got some great things in the pipeline. So congratulations on that. So keep us up to date on these things as they roll out. David,
Of course.
what's going on with what you're seeing out there for 2022 and what's capacity up to?
Yeah, so for those who don't know, Capacity is a support automation platform. David, what does that mean? We are here to help you automate as much of your internal support for your mortgage advisors and external support for your borrowers. So when I think about the three big trends that we're seeing, I've got a quick story for each we're going to walk through of a specific case study from an existing client, and then we'll kind of extrapolate out some of those trends. So first example, we're working with folks like PRMG, who are now closing loans 11 days faster than the national average of 47 days. Now, how in the world are they doing that? They're doing that by automating every piece of the mortgage process. We have a built-in integration with Sales Boomerang, by the way, so we play really well in the sandbox. I'm super excited about that, to announce that. But when I think about we were talking about a lot of F words here earlier on fear. I think one of the big F words we don't talk enough about is friction. What is the friction in this process that's keeping our advisors from getting things done? So trend number one, when we head into 2022, mortgage advisors are going to gravitate toward organizations that close loans faster, that pull that friction out of the mortgage experience. That leads us into our next slide here on just a quick poll we wanted to do. What % of your mortgage advisors are going to choose to stay with you based on your tech stack? Said another way, like how many of them really care about the tech stack? How many of them this is a not important feature?
Great question.
So the audience can just click on this number.
Yeah, we'll
click on the bubble, I should say.
Yeah, and this will populate the results, I believe, right? We'll get to see what people are saying. There we go.
There you go. So
wow,
looks like let's say half of your mortgage advisors, your tech stack is either 75% or 100% driving their decision to stay. Awesome. Think about that for a minute.
Wow.
So
David, just a quick question on that. Sort of your sense and your typical mortgage company, who's involved in those decisions about what to include in that stack, and are more and more lenders including their sales force and helping to make that decision?
Yeah, so what we're finding is that as more and more organizations have moved various parts of their org to the cloud, anything from the Microsoft Office suite to their LOS to POS to the different pieces that they use, these tend to be great systems of record, but terrible systems of engagement and missing systems of intelligence. So on the engagement front, the way that we like to think about it is that we believe a natural language interface is the most natural way to get an answer to a question, whether that's internally on Microsoft Teams asking about, say, the status of a loan, or whether that's a first-time borrower on your website trying to understand, what does it look like to do a cash-out refi? They're doing that for the first time. I think on the system of intelligence piece, the workflow automation of taking the various backend processes, tying into all of your favorite apps, including apps like Sales Boomerang, I think that process is what is significantly driving that time down. So anything you can use to remove steps out of the process is so important. The other thing that we're finding is that, to your point, this is not just a top-down, okay, one executive thinks this is a pet project, somebody's cousin said AI is going to be big, let's go follow up on it. This is being driven bottom up from mortgage advisors coming back and saying, hey, I want to work with a stack that's easy to use, that doesn't have me doing superfluous amounts of clicks, that doesn't have me jumping through hoops to find information on what's going on with these loans. And so it is very much not only just a top-down, but also a bottom-up process that's happening. Cool. Next slide. All right. So, okay, David. So great. So you've got this technology. You've got these bots that can answer questions. It's plugged into your CRM. It's plugged into your LOS. It's plugged into your sales tools like Sales Boomerang. Like, what kind of results are people getting? So our friend Catherine Campbell over at Assurance Financial, she's Chief Digital Officer there. Since implementing capacity, she is now getting 96% of her team's inquiries are answered within under 2 seconds. And this is
Amazing.
every hour of the day. This is multiple platforms. This is internal. This is external. This is, like I said, eliminating a lot of the steps that people have to go through.
So
Now, you said,
David,
yeah, go ahead.
interrupt. So is this is online?
Absolutely, yes.
It's not like, I mean, it takes me longer than that to dial a number or get an operator. So these are online inquiries, less than 2 seconds. I mean, that's
Yes.
amazing.
Type in your question into the bot. It will auto-complete and actually predict what you might be asking about. You can either type it in and hit enter, or you can select one of the pre-selected items, comes back instantly with a response. And then even in the rare chance that it can't answer your question, it will intelligently escalate that up to the appropriate team. So think about like automating underwriting questions. Bot's going to answer a lot of them. Anything it can't, it appropriately escalates up.
So it's faster than humans can think. I know that, like, sometimes I will be on some kind of automated system and it'll say, oh, it'll ask me a question and then I'll answer it. And then you hear this little, and you think that's not real. What that doing is the computer is slowing itself down. So I don't, so it's not that fast. But that is an amazing statistic that jumps out at me. So congratulations.
Yeah, no, it's been great. And if you kind of extrapolate this back up to the trend itself, the trend is that team members expect to have a single place to get an answer to their question in a frictionless way. So you don't have to go jump through a bunch of different systems. You don't have to talk with 10 different people. The best compliment I've gotten in the last 6 months was one of our clients came back to us and said, David, we've retired not 1, but 2 email inboxes because we no longer need to have that support at email inbox anymore. Kathy's handling the whole thing. Said another way, most organizations are running more like Blockbuster in the 90s, where you got to go in and look for your VHS tape and try to find what's in stock and go see if it's there. And maybe you call the other location because you didn't have it in the one. Compared to what Netflix has done for the consumer side, it's the exact same process with capacity.
So David,
Great analogy.
Are they reducing the number of employees in these spots, or are they repositioning those employees who were doing these sort of low value tasks to higher productivity work?
Yeah, I mean, look, one of the big trends we saw in the chat earlier was just the pain on recruiting. So most of our clients are not using this to do team member reduction. They're just using it to plug holes and be able to fill in where they need.
Makes sense.
Last trend for us on the end here, and this is going to be a little bit more of a guided journey. So I want to talk about our friends over at West Community Credit Union. So West Community, this is publicly facing. So this is borrower facing. They get 89% of their inquiries automatically responded to. And you can go to West Community Credit Union's website, check out the bot there. This is allowing their team to focus on more value-added work. And in fact, we're rolling out an intranet version of this same platform for their internal team. Their internal team demanded it because they said, we get better information asking the capacity bot on our website than we do on our internal SharePoint website trying to navigate.
What a great testimonial. I mean, honestly, that's amazing. Like, I'm going to go ask a chat bot about my own business instead of asking. That's beautiful. That just talks about that exact thing that you just said about Blockbuster and Netflix is just better organized, and easier to get access to. I love it.
Absolutely. Next click, please. So after implementing capacity, their net promoter score went from 75 to 85. So they're very big on tracking their borrower sat. And
Can you tell
so,
everybody what net promoter score really, so everyone knows what the one question is, so everybody understands what that is?
yeah. So the baseline idea behind net promoter score is like, what is your likelihood to recommend this particular product, service, company, et cetera, to a friend? It was developed, I think it was either Bain or BCG. One of the big consulting firms about 20 years ago came up with this methodology, and it's so simple so timeless and being used across all these different industries. And so for them, they said, look, David, this sounds great. Everybody likes to talk about engagement, but we actually measure that before and after the implementation. And oh, by the way, our prospects are becoming better informed by this. Next click, please. So over that time that they've implemented with us, their assets under management have grown by over 50%. And again, they're credit unions, so they have both, kind of both sides of the house there. But the big stat I want to leave with is that we've reduced their phone costs by over 20%. So you've got 89% of questions getting answered instantly. You've got SAT going up 10 points. You've got a bigger overall business, and you've got lower costs. In most organizations, you can pick two out of higher revenue, lower costs, or better SAT, but you can't get all three in one kind of implementation. But with capacity, these are the types of results we're saying where, no, you don't have to pick two out of those three. All three of those are attainable with just providing a better, frictionless, more Netflix-like experience, both to your team and to your borrowers. So last trend we'll leave you with is we really think that more and more organizations are going to turn to this, not as a nice to have or as a, yeah, we'll get to it as a pet project, but they're saying, look, in an environment where refis are down or purchases are up, we're going to need to better inform our consumers about why to choose us. And that's part of what capacity does.
Fantastic.
All right, Dave, Alex, Mike, Dr. Fratantoni, thank you very much. Just some amazing things going on out there. And one of the things that I hear in my travels and in my emails is, is technology going to replace me? Am I going to go the way of the ice salesperson or the whale oil manufacturer? And I always reply no. And in fact, in 2020, we learned just how important the loan officer is in terms of interpersonal relationships and so on. But the question that should be predominant is what is the technology that can best help me help my clients? And I think we've seen some great examples about that. And we led off with Mike talking about why it's going to be so important for technology to be used appropriately by originators because of the constantly changing environment, whether it's purchase or refis, whether there's appreciation, depreciation, regardless of what interest rates are doing. They need to be on top of things, and they need to be able to use the tools that are available. And these are some great tools. So I know we've set up, or not set up, but we've got a large number of chats or of questions that have come through. Do our panelists, have you guys had time? I know that your eyes are up on the screen here, but are there any questions that you would like to answer that you've seen in the chat box that might be useful to everybody? And I'll start with David, or actually, I'll start with Alex, because Alex, you've had a little more time there in the chat room since David's been speaking. Anything that stands out to you that you'd like to answer?
I think we've answered throughout the conversations in chat, and I see our team here getting involved with the chat and answering some questions. So I don't really see a question directly for Sales Boomerang that I could address here. Somebody wanted to learn more about the reverse mortgage piece of it and how that's going to work. We would love to show you. That's definitely more than 3-5 minutes of conversation. So I don't have a question that's in this chat to address. I would thank Craig publicly here for the wonderful sentiments and words that he mentioned in the chat. That's lovely. And look, you know, our position is always like this. We set out almost 5 years ago to prove that a database is more valuable than anyone gives it credit for. That's been proven now. And going into 22, 23, it's now going to become more important than ever, because somebody did mention in a chat here, $1,000+ to acquire a client can't be the way that this business moves forward. There's got to be a better way, which is why one of the things we always mention is there is a better way. It's not the only way. You shouldn't rely on your database for everything, but you should rely on your database as a baseline of a predictable number that you know you'll be able to help in your database. And so, and to help those people, it is around $300 versus $1,000. So I will address that as that came up in the chat. But just understand, it is so important, so valuable. It's been proven over and over again, especially with these companies going public. Your database, the retention of your database is so important. The tech stack that you have with David, with the question that David asked, and the integrations between your tech stack, and I'll leave it at this and we'll hand it off to David. It is so important to play Lego tech right now. Do not invest in technology that doesn't work with your existing technology. Do not do that. Do not silo. Do not force your team to learn 5 systems to use.
Amen, brother.
Amen, right? And listen, capacity is just such an incredible organization. The way that you simplify efficiencies, take out friction, it is remarkable. And it fits in well with other technologies. That's who should be investing in. Capacity is a company most definitely to invest in, because it fits so well with existing tech stacks. Don't silo your team. Don't silo your tech stack. Play Lego tech. Why do I say Lego tech? You buy any Lego set from anywhere in the world and they will work with your existing Legos pieces at your home. That's what you want. And so I'll leave you guys with that. And maybe there's some questions David can answer in the chat.
Yeah, I just have one that was more of a comment. We're asking about, you know, if you could lower the borrowing, if you could lower the closing costs, how many more borrowers can we bring in? I think that's absolutely a question to start asking. I think there's an analogous question people were asking in the world of the pharmaceutical world, where they said, you know, part of the problem with our pharmaceutical sales as a nation is that we have pharmaceutical companies that are negotiating with individual countries one-off, when they could go in and buy a block and have a lower price per sale, but have a much bigger volume of people to go after. I think there's a very similar type of analogy here of saying, look, as the volume of borrowers starts to go down, particularly from a refi perspective, let's go figure out how we can get more people into the funnel.
I agree. Well, once again, thank you very much to our panelists. And so much great information, so many new cool things. We're going to give, I think, everybody a minute or two back of their day, and finish 2 minutes early. So
Thank you all.
Thank
Yeah,
you.
Thanks, Alex. Thanks, David.
That's amazing to finish a webinar 2 minutes early. Does that happen anymore? I don't understand.
It does. It just did, man.
It just did. The impossible is possible. Thank you, Rob. Thanks, David. Thanks, Dr. Mike.
See you
Take
later,
care, everyone.
Take care, everyone. Thank you.